Bob, why don't you give us our mortgage update? What's going on, man?
Absolutely, guys. Well, as we expected last week, the Fed statement, we got that as expected. The Fed hiked 75 basis points, bringing the Fed fund rate up to that 4% level. But they did change a little bit of their language. And we'll kind of talk a little bit about that. I'm going to kind of read their quote for a second, just because it has language in there that's very important to how we're setting up the December meeting and what happens in the future. But they said in their meeting, or in the statement following that 75 basis points, that in determining the pace of future increase in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Okay, so that's their start of quote, end of quote. Now, what all that means, guys, is we were thinking they're getting this a little bit, like how their decisions to change interest to change the Fed funds rate were impacting people, because like when they increased that Fed fund rate from 3.75 to 4, or what have you, we don't feel it immediately, right? As a consumer, we're not feeling it that day.
Hmm.
So what happens is when we get our credit card statement 30 days later, that's when we actually feel the pain, and when we write that check. And that's the lag they were talking about. So after that statement was released, the stock and bond market rallied. And it
Hmm.
really appeared that the Fed was not only, maybe looking at a 50 basis point lessening in our Fed hike rate in December, but maybe even potentially pausing it pretty soon. So we felt they were getting it, that rate hikes operate on a lag and that they may be doing too much, right? So then the Powell press conference happened, and it was a completely different story. Powell confirmed a slowdown was coming over the next two meetings, but went on to say that it would be premature to be thinking about pausing, and that the Fed still has a way to go. He
Okay.
also said that he would rather risk overdoing it and hiking too much rather than underdoing it, as the Fed can always cut rates in the future. And that caused the market to freak out. And then, the stock market sold off sharply. So did the bond market. That sold off pretty sharply on Friday. And here we are, here we are today.
Yeah.
Um, that's almost like the Fed, like the Powell's like out of touch, right? I mean, they make a statement that they're starting to understand the impact of the lag to the consumer. But yet he comes out now with a very firm statement that they would rather overdo it
Hmm.
than underdo, because they can always go back and recorrect with future rate reductions.
Goodness
So
gracious.
yeah, so it put us in a little bit of a predicament. Friday we had a good little run. Wednesday, Thursday, we started to see bonds pick up. We had a little bit of rate reductions on Wednesday, Thursday, and then we gave all that back on Friday when all that statement had time to digest.
Yeah.
And then today we're down a little bit on the basis points. So
Goodness gracious. Well, hey, I know we've got eyes on us right now. We are live streaming, and I
yeah,
want to encourage people to go ahead, and if you have any questions for Bob about mortgage, the update, um, please feel free to put that in the comment section, and we can get a live reaction from Bob.
yeah.
Man, well, in layman's terms, where does that put us, for people that are looking 30-year fixed, or you got
Yeah,
people
I
that
mean,
are waiting to lock, for instance, a lot of new construction and people are waiting to lock. Or do we like tap brakes on the lock and try and wait till next week if they got a house that's going to be done around February, around
yeah, I mean,
January? Like what?
I'm it's a very personal conversation I'm having with these clients about risk, right? What
Okay.
their tolerance is and how comfortable they are with risk. There are locks that'll go 4 months out,
Hmm.
right? So you can lock a loan for 4 months, you can lock a loan for maximum 6 months, right? And if they're very low on their risk radar, then we may choose a 4 month lock to protect them. The challenge we have on the other side of that is, will the home actually be finished when that lock expires? Now we can relock it, or not relock it, but we can extend that lock. It just costs the customer money, right? So for a 30-day extension, it's half a point, right?
Yeah.
So it's not like it's chump change. I mean, it costs some money to extend that lock, but it protects it protects the customer where they are today. It's really more about, how long they plan on keeping the house, and do we
Right.
feel like it's a better strategy to wait and then lock in at that point, because the 4-month lock and a 6-month lock have upfront fees that they have to
Yeah.
pay to get it. Now they will get that money refunded back at closing, but they
Sure.
just still have to come up with some money up front now.
And
Or
you
do
have
we
to close.
Yeah, exactly. They'll get it refunded back at closing, yeah. Or do we go ahead and wait for what we and our analysts are telling us, "Hey, get into 2024, and we will potentially see those rates start coming back down." And then we just take what we have today and then sit on that loan for 12 months and then cycle through a refinance, and get the rate that you're ultimately looking for today. So we talk a lot about that with clients. We also are obviously doing a lot of 2-1 buy downs right now. I mean, a big portion of our pipeline ends up being a 2-1 buy down, which basically means, let's say a start rate is 7% today. That means you're going to start your first year payments based at 5%, right?
Okay.
So that interest rate is going to be 5% the first year, 6% the second year,
Uh-huh.
and then the third year it goes up to the 7% for the remainder of the loan. So it's
Okay.
not a bad plan if we feel like we want to refi, after year 2, because we have a blended
Ah,
rate
Sure.
that's much lower than the current market rate. The
okay.
the challenge is, it's just the seller has to pay for, that buy down subsidy, right? Because somebody still has to pay for the um the interest rate, or yeah, the interest rate subsidy. So on a $534,000 house, I mean, that's $12,446, right?
Sure.
So they would pay for that, but then that would get the payment starting at 5% and then 6%. So it does help the buyers, considerably.
Yeah. Yeah. No, I can definitely. I appreciate that. When I hear you say sevens, that just kind of lets us know where we're at a little bit in regards to
Yeah.
where rates are at. But
Yeah, no points
it's
are in the sevens, and then, I mean, you can still get into the sixes. It just takes some points, right? So that's
sure.
the
Mhm.
consultation and the strategy. Does it make sense to pay the points based on whether we're
Sure.
refinancing or we're going to keep this loan long term?